Today's episode is brought to you by Kelleher & Buckley Law Firm. Smart business owners recognize that sound legal advice is critical to future success. The attorneys at Kelleher & Buckley have been providing legal guidance to families, business owners, and C-level executives since 1997. From employment law and compliance issues to buying, selling, or merging companies, the corporate attorneys at Kelleher & Buckley advise businesses across a wide variety of industries and professions. Over the years, co-founders Andy Kelleher and Dave Buckley have assembled a team of highly skilled attorneys to create a full-service law firm. I've gotten to know and have done deals with Andy Kelleher, Dave Buckley, and their team. They are truly a full-service law firm with outstanding talent. To find out how they can help you protect your assets and your future, contact them at kelleherbuckley.com. That's KELLEHERBUCKLEY.com. Hope you enjoyed today's episode. Thank you.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
Valuing a business can be hard enough when things are going well. Valuing a business that has been impacted by the COVID-19 pandemic will be tricky at best. We're being joined today by a real expert, Dr. Alexandra Lajoux. Dr. Lajoux has so many accomplishments, I couldn't even begin to cover those in this intro. And I think we're actually going to have a hard time even covering it all in the show notes. She's accomplished so much and been involved in so much in the M&A world. At a high level, she is the founding principal of Capital Expert Services, past president of Alexis & Company, serves on the boards of several organizations, and she has authored or co-authored all of the books in the McGraw-Hill Art of M&A series covering strategy, valuation, financing, structuring, due diligence, integration, as well as financially distressed M&A. Dr. Lajoux, welcome to M&A Unplugged, and I'm so excited to hear your perspective on the current and unfolding M&A environment.
Thank you, Domenic. It's a pleasure to be here. I'm eager to hear your questions.
Really, that intro doesn't do you justice. You have accomplished so much, and you've been involved in so much. Could you please give folks, fill in the blanks a little bit so folks have a really good sense for your background and what you've done, and then we'll dive in and start talking about how buyers and sellers should be thinking about evaluations during this post-pandemic environment.
Well, great, Domenic. I will. And it's funny, preparing for this interview took me on a trip down memory lane, and I realized that valuation of businesses, including distressed businesses, is very much a part of my life. I grew up in the household of an entrepreneur involved in M&A. He was an M&A consultant, and he created and sold several businesses. Stanley Foster Reed was my father. He founded the publication Mergers and Acquisitions. And even though in my early life I had other aspirations, I wound up in the field, and he was my original mentor. Buying and selling companies was the story of our life and pretty much sent me to college. And then my lifelong career was with the National Association of Corporate Directors. I'm retired there, but I worked there for 30 years. And that was an organization that started out very small, grew organically, but then took a leaps and bounds growth when it acquired another organization. So I saw how that worked. And then I myself have been a bit of an entrepreneur. I'll start a business and stay with it. I appreciated what I heard about the personal gratification business on a recent interview with you. And I think that's been kind of my story for those businesses. But I've always been aware, as you've mentioned in some of your writings and interviews, that one should always think about the potential value of a business when it's going to be sold. And so I have some thoughts about that as well. But that's the story of my life from a lens of business valuation.
Wow, I don't meet very many people who grew up around M&A, so you have a unique perspective almost your entire life around this.
That's right.
That's great. Well, so, this is a unique time, and I've thought about the parallels between this and the Great Recession of 2008, and then
Mhm.
previously the crash in 2000, 2001. But somehow or
Mhm.
another, this feels different. Like we've had our entire supply chains shut down, most of the economy shut down with the exception of essential businesses. Have you ever seen in all your years anything that might look like this?
I have not, Dominic. I agree. It does seem to be unique. However, some of the lessons from past crashes that we've all survived do hold true. And I remember a financial advisor of mine, he was with UBS and he's now with Wells Fargo during the worst of the economic crisis. He said, as long as people are willing to get up and go to work, there will always be value. There will always be an economy. There will always be prosperity. In other words, we can rise from those ashes. We can look at what the balance sheet looks like, what the cash flow statement looks like, what the income statement looks like, and it can all look very grim and gray. But if the owners, if the customers, if the suppliers, if the employees, if the contractors have a will to continue and have built up goodwill in the most general sense, there's always hope. I'm a huge optimist on the value of businesses, no matter what. And if you think about it, Dominic, and I try to be brief here, but think of all the high tech companies that are always pre revenue. They have zero revenue, they have nothing but lots of liabilities, lots of costs. From a financial statement point of view, they look terrible. But perhaps they've come up with some idea that has great value, that has great sizzle, and that can attract capital. That kind of phenomenon is not dead. Value is really quite ephemeral.
Yeah. Well, I'm so glad to hear this message. And I do think that's a great message and a great lesson because even in our M&A practice, we're getting calls every day from clients, buyers, sellers, and asking us what's happening. Is there any activity? Where are the lenders on
Mhm.
deals? And interestingly enough, I mean, we have continued to maintain momentum. Now, people
I
are
bet.
being way more cautious, right? I mean, deals that were going along smoothly, people have put the brakes on a bit, but they haven't stopped. I mean, they're just making sure that they're doing thorough due diligence. And we've closed a couple of deals in this quarter. And so I think it really highlights and illustrates your message that there's always value out there.
Mhm.
Sometimes you have to look for it a little bit deeper and it takes a little bit longer, but there's always value out there. Maybe we could take this conversation, sort of look at an environment like this where some companies are doing better than ever because they happen to be in sectors that the demand is increased, but that's few and far between. Most are holding their own or they've seen substantial decreases in revenues. If you're a buyer or a seller, and maybe we'll take it from a seller's perspective first,
All right.
how should you be thinking about the value of your business while we're in the midst of this pandemic? And how should people approach looking at a potential exit of their business and the value of that business?
Oh, that's a great question, Dominic. And I think that's the key question. Again, I'm an optimist about value. It drives me crazy when people say, well, it's only me, myself, and I've had a great run. It's made me money, but the business has no intrinsic value. Well, I beg to differ in most cases. You look, first of all, there's a brand value that gets built up. That has value attached to it. If there's been a website, if there's been a lot of traffic to the website, if someone coming along and a potential acquirer is not into building websites and creating Google findability, that has value. The people the business employs or engages as contractors or even vendors, that has some value. Perhaps the company has a tax loss that an acquirer wants to use in the future if that acquirer happens to be one of those rare businesses that has high revenues. Perhaps the company has established a great track record of governance paperwork, paying all the licenses and all the fees, and possibly even has an IPO paperwork started, or in the case of a shell public company. It costs a lot of money to just build the paperwork for a business, and somebody else might want to come along and take that over and save him or herself the pains. Also, there's the old-fashioned idea of replacement cost. Hey, I've spent $1 million building this company. You want a similar company. Do you really want to do it by yourself in today's dollars? Wouldn't it be better to take it from me and then move forward and save yourself a lot of time? Then there's the idea, the very value of a founder's willingness to stay. If the founder, who is the great be all and end all, is willing to stay for a while and bring customers forward, bring that goodwill forward, that has a value right there. And in terms of the actual sale, the founder doesn't have to say, I want all the money right up front in cash. The founder can have the possibility in a negotiation to say, well, I'll take a contingency payout. I'll take a part of I think my business is worth X million. I'll take part of the value now. I'll prove my point. And going forward, I'll share the risk with you. I'll take a payout, but it will be a lower payout if things don't go as I optimistically predict. Yeah. And so I'm always a big fan of lawyers, those contracts. How do you define act of God so that if, God forbid, COVID strikes, the parties are well aware of how you're defining act of God? Does it include a pandemic, etc.? So these things might sound technical and narrow, but taken together, that's the entire experience of M&A. And that is what keeps our economy going. If you think about it, most companies are privately held. Acquisitions are much more common than we realize. The bean counters say, well, there were 48,000 acquisitions announced globally in 2019. Yeah, okay, 49,000 globally in 2019. But that's only announced acquisitions that were worth $5 billion or more,
right.
Bottom number. But think of the thousands of businesses that change hands every day, and you're the one who's has the catbird seat for that.
Yeah, absolutely. Absolutely. So I think what you're highlighting for the M&A Unplugged audience is traditional valuation methodologies of a multiple of EBITDA. And not that that's the only way to value a business, but, most companies take that approach is you're looking at, a multiple of your EBITDA.
All right.
We're going to have to have a recalibration of that during this time, right? I mean, we're going to have to rethink other ways to value a lot of the things that you're pointing out, or I think you're also suggesting that maybe you stick with a multiple of EBITDA, the EBITDA being pre-pandemic EBITDA, and the owner, if they really believe that the business is going to come back, agrees with the buyer, they're going to take a good portion of that in contingent payments, whether that be an earnout or a contingent note, because they believe in their business and they believe it'll come back. And if it doesn't, for some reason, the value probably winds up being what the true value should be. But if it does come back, everybody's happy and there is full valuation realization. Is that right?
Yes, and I'm glad you mentioned EBITDA because that kind of comes and goes as a fashion. And I know even the Financial Accounting Standards Board calls that a non-GAAP metric, and the SEC is leery of it. But it's a great metric, earnings before interest, taxes, depreciation, and amortization. And yet, ultimately, that's an accounting term. Yep. And accounting, as you know, can be somewhat managed or manipulated. And that's why, even in Wall Street, they love that discounted cash flow. That is, it's so clear, it's so obvious. But that, rather than being manipulated on paper, that actually can be affected by new policies. For example, just pretend that I borrowed X amount of money to start a record label, and then I put music out there, and I'm getting a cash flow every month from CD Baby. And if you compare the payments on the debt that I'm paying to the incoming cash flow, I have positive cash flow. So that's already a start right there. And so if you say discounted cash flow in the future, well, what does it look like if I have the possibility, if interest rates are getting lower or going down to zero and the value of money increases, that discounted cash flow will make my business look very good. So EBITDA is not the only measure. I'm not disrespecting it, but I'm saying also discounted cash flow is good. And then there are obviously comparative transaction metrics. And one of the great treasure chests of valuation techniques are the courts, because people are always suing that they were either shareholders sue because they say the management overpaid for an asset, or a buyer is suing because the buyer overpaid, or the seller is suing because maybe a minority shareholder of the seller, that the seller was underpaid. And in the courts, they bring in expert witnesses such as appraisers to give an opinion as to whether or not the price was fair. Fairness opinion doesn't have to be a fancy investment banker; it can be an appraiser. And you find all kinds of interesting defenses of prices and interesting theories. And there's just a multitude of things. And you've got to know, Domenic, that if someone devotes a life to building a business, there's got to be value there. It's just because God is a just God. How could it not be? How could it not have value?
You're bringing up such a great point. There isn't one methodology, right?
Right.
There are multiple methodologies to arriving at value. And even, if you're using them all as litmus tests to make sure that you're getting within a range of value, I think that's a great approach. Dr. Lajoux, let's shift gears here a little bit. So, we've talked about the sellers and maybe the sellers having to shift their mindset, think about all of the intrinsic values that are in the business, and maybe think differently about how they receive the consideration, maybe not all up front, but over a period of time. Let's shift gears to buyers. I mean, buyers, are going to be cautious in this period.
Oh,
right?
right.
They don't know what they're walking into.
Yes.
They don't know what the future holds. They don't know how quickly a business is going to rebound. Yet, we are in this environment where there's tremendous amounts of capital sitting on the sidelines, interest rates at historic lows, and acquisition, I think, as you pointed out, being a tremendous way to grow. So what should buyers be thinking about during this pandemic as they approach acquisitions and the valuation of those acquisitions?
I agree with you. They do have to be cautious. I think it all starts with the buyer's management team asking itself, what is our strategic plan? What is our core business? What is our vision? What is our mission? And that energy and those values propelling forward to say, is this something we can do on our own, or should we find a partner? And if we find a partner, should it be in a joint venture, or should it be through an acquisition? Should it be through a merger? There are all kinds of different ways to accomplish this more collaborative approach to prospering. So why wouldn't any company be open to the idea of combining with another company in some way, shape, or form? So when it comes to actually spending money, as you say, it's there, it's available, you can borrow it. The interest rates are very low. So in any event, you'd have to give a business plan to your lender anyway. And that's a good way to soul search and say, is this something we want to do? And then the buyer would look at, if we decide to acquire this company, are we just going to take an ownership position and let it run itself and get some payments out of it? Or are we going to combine our operations to some degree? And that's where all of the great writing and thinking about merger integration comes in, because it's so key. Do we combine sales forces? Do we combine brands? Do we consolidate branches and all of that? And when you have mergers of equals, of course, you save money, because sadly there's downsizing usually. Other times when you have mergers of complementary companies, you can really prosper together, but then at the same time there might be some clashes. So mergers are risky. There's no doubt about it. They're highly risky. I think their riskiness is quite overstated. There's a very popular statement that 80% of mergers fail. Actually, every good analytical scholarly piece I've read said it's about a 50-50. That's still risky, but it's hardly a guarantee of failure.
Interesting. I didn't know that statistic. Even 50% makes you, take pause. Going back to, you better have your plan really crystallized, and your integration plan as well, because we know through experience in our firm that even the best mergers on paper, unless there's a good solid integration plan, you're headed for rough waters.
Yes.
So you're a buyer in today's market, uncertain about what the impacts of the pandemic are going to be and how long it's going to be and whether or not there's going to be a second wave and what happens to supply chains. And how do you approach companies that have been impacted by COVID-19? Are there extra precautions you take, advice that you would give to buyers out there as they look at businesses that have been impacted?
Again, another great question. My approach is based on the idea of diplomacy. If you know that a company is struggling and it's losing revenues, it's losing people, you don't want to appear to be a vulture taking advantage of their vulnerability. It's morale of the seller is so very important. So in approaching a potential seller, you'd want to really let them know how much you value what this company has accomplished, the value of what the carry forward brand and so forth. I know it sounds counterintuitive because eventually you want to negotiate the lowest possible price. So you'd think you'd want to act indifferent and put them down. But I guarantee you, because selling in and of itself is somewhat of a traumatic event, you need to create conditions in which the healthiest relationships can occur. Because you don't know, if you don't merge, you might decide to form a joint venture and you need a lot of goodwill there. So I would say that thinking about COVID, know that it's done a lot of damage already to these companies and that they're probably going to be willing to sell accordingly. But make sure that you convey the idea that everything they've done so far has been very positive. This is why you're approaching them. And then engage in a dialogue of what you can do together. And it's so interesting about COVID-19 because remember, it was something like 15 years ago when the idea of the uncontrollable risk, the unpredictable risk, the black swan, and remember in the Desert Storm, we were talking about the unknown unknowns. That's what we're dealing with COVID. We have an unknown unknown. And yet there's that wonderful grid where you have the known known, the unknown known, and the unknown unknown.
Yeah.
We're right there over in the unknown unknown. And, what have you got to lose? If the world itself is coming to an end, just follow your bliss and do the right thing, and everything will work out.
The point that you're making about the morale of the seller, I think, is such an important one. We have a motto in our office that every good deal starts with rapport. Sometimes buyers come in and they just want to look at the memorandums and the financials, and they don't spend enough time building rapport with the seller. And then invariably, if there's an agreed upon letter of intent, if that deal hits bumpy roads, the relationship wasn't there to get through those bumps. And I think during a pandemic, it's even more important. And unfortunately, this environment does bring out in some people the worst. We get the calls every day from people saying, "Hey, I want a business that's down on its luck. That's what I'm looking for."
Right.
And you can just tell they want to pounce. And look, it's a part of the market, and it's always going to be there, and there's no way around it. But if you're in it for the long haul and you expect the cooperation of that seller,
right,
you have to approach it, I think, as you said, understanding the morale of the seller and keeping their spirits up and trying to build rapport.
Exactly. Very true.
Yeah, I think these are all great points. Alexandra, let me take it up a level here. And just at the highest level, you've lived through any number of down cycles. You've been in M&A. It sounds like you've been exposed to it almost your entire life. What advice do you have for people at the highest level right now that they should take away from this conversation?
What comes to mind, Domenic, is believe in yourself. And I know that sounds very general, but whether you're a seller or you're an acquirer, stand in your integrity, believe in yourself, believe in everything you've accomplished to date. You're going to acquire well, you're going to be a great acquirer. You're going to ask the right questions. You're going to have the right outcome. If you're a seller, everything you've done in your life, you've done it right, and you're coming into this negotiation with a strong integrity. And as I say, believing in yourself. I think attitude and morale are so important. The diabolical nature of a pandemic or an economic crisis, and we're facing both, is that it saps you of your confidence, it saps you of your strength, it saps you of your vision, your channel, your ability to communicate. These are real risks. One has to keep all of that at bay and focus on all the positives you've accomplished, whether you're an acquirer or a seller.
Yeah, I think those are great points. I mean, we're keeping this high level. There's probably so much more we could explore, especially as it relates to diligence and integration and the banks, because I know you have deep knowledge and experience in all of those areas. Is there anything related to diligence, integration, or lending that is worth mentioning here?
Well, the word that comes to mind here is contracts. Don't just leave it to the lawyers to read and understand all the contracts. Contracts with lenders, contracts with employees, contracts with vendors. You want to make sure when you're doing due diligence with any corporation is that it's a bundle of contracts. It's nothing more or less. The corporation you're buying has made certain promises, and you as an acquirer will probably inherit all of them. And so some of them will hamper you, some of them will empower you, and you need to make the distinctions. So your choice of an attorney is very important. And you want an attorney to guide you in understanding the fullness of the contracts. And please don't just delegate it to an attorney who doesn't include you, because there's so much opportunity and risk within those contracts.
Yeah, I think it's another great point. I interviewed a couple of weeks ago 2 attorneys, and we did point counterpoint. And one attorney took the seller's side on an issue. The other one took a buyer, and we talked about reps and warranties.
Yes.
And reps and warranties and indemnifications are going to be front and center now during this pandemic, right? I mean, they've always been important, but now there's going to be a tremendous amount of importance on this and how they're worded and the survival periods. And so I think your point is well taken. Hire advisors, whether they're attorneys, accountants, whoever they are, that have deep experience, and make sure that you understand everything that's happening. Don't just take a back seat. I think it's tremendous advice. Dr. Lajoux, this has been tremendous. Any last minute comments? So we're going to wrap up here. And then I'd also ask if people in the M&A Unplugged community wanted to get in touch with you, if you could leave some contact information so they could reach out to you.
Oh, thank you. Well, I'll just make one touch point, and that is that I forgot to distinguish between tangible and intangible assets. And I find that the category of intangible assets is endlessly interesting. And there could be a case in which you want to buy a company and it has some intangible assets that have not yet been protected. There's no patent, there's no copyright, but there could be, or trademark, I should say. There's about copyright in this day and age. Certainly trademarks and patents. So that's a whole gold mine right there. The way to get a hold of me, if anyone wishes to, is A.R. Lajoux, my name L-A-J-O-U-X, at capitalexpertservices.com. But if you just Google my name, Alexandra Lajoux, you're going to see lots of business, a little bit of politics, a little bit of music, and that's me. I think I'm the only one out there on Google. Alexandra Lajoux. You'll find me.
Tremendous. Well, thank you again for being here. It's been such a pleasure.
Thank you, Domenic.
M&A Unplugged community, all of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.